Welcome back to Surveillance Midday. I'm Michael McKee, in for Tom Keene today. My co-host for the day, David Rosenberg from Gluskin Sheff, and we have been joined by Sri-Kumar, the chief strategist for TCW. We were just talking, Sri, about Europe. It is the top question for everybody these days. And David asked me, are you bearish or bullish on Europe? I'm not really sure at this point. People seem to have changed their minds on a regular basis about whether or not they're going to be able to get out of this.
Yeah, I think, Michael, the answer to that question is bullish or bearish, short-term or long-term. You're going to answer back, say, with a question. After having been negative on Europe since the first Greek bailout in May of 2010, in the last month or so, I've turned optimistic for the first time. That doesn't mean that you immediately have a turnaround, but I think the end game is here. I think this is the beginning of the ninth inning. There's going to be a big shoe to drop, and if you are willing to go through with that, and if you have a strong stomach, mid-2012 is roughly my date where all the positive things start to happen, when distressed investments in Europe start to bear fruit. And this is very similar to my experience with Latin America in the second half of the 1980s. I think that's where we are now.
Well, when do the markets start to show? You brought along a chart of spreads there, just show that investors still don't think anything is on the immediate horizon.
Absolutely. I don't think the spreads are ready to show that yet. And if you, even today, for instance, the French spread over Germany went below 100 basis points for the first time in several weeks. I don't believe it's permanent. I think it's all because of yesterday's liquidity creation move. The permanent reduction in yield is going to come with through one of two different paths, maybe a combination. One is a debt reduction for many of these countries, which means they are going to be able to service the debt in the future. Second point, Michael, is significantly more money creation by the European Central Bank. Mr. Draghi happened to indicate that he was doing a trade for fiscal austerity, fiscal discipline, for more money creation on his part, unsterilized money creation. So both those are the two ways, and once they are done, the spreads start to come down.
Oh, that's very interesting. So Draghi's already indicated that he'd be willing to embark on quantitative easing?
There is a statement today. He doesn't say quantitative easing, but the indication is that there could be a first signs of money creation, unsterilized, meaning not what we saw earlier this week, David, when they could not sterilize it and banks could not afford to give that cash back. The suggestion seems to be the beginning of a suggestion anyway, that he might do that in exchange for fiscal austerity.
So let me ask you a question. You said that you're expecting the light of the tunnel to happen in the first half, by mid-part of 2012. Is it, that's 7 months away. Do you think it's maybe a little too early to start reallocating towards the equity market right now?
You did. Good question.
Because there could be more shoes to drop, I would suppose, in the next several months.
Absolutely. That's why I said to Michael earlier that it depends on the time horizon you're looking for optimism. You don't want to go into European debt or European equities today. Maybe you don't even want to go into it in 2 or 3 months. But what I am talking about, David, is more countries which either default or debt gets restructured. We are seriously talking about, let's say, 10% haircut on Italian debt, 15–20% haircut on Spanish debt. Then you ask the question, how are the banks going to recapitalize under that setup? It's not going to be easy. Some of the banks essentially either have to get nationalized or massively dilute their shareholders. When those things start to happen, that's the end point.
You mentioned Latin America. That what got us out of Latin America was Brady bonds, but
exactly.
they don't want Euro bonds.
They don't want Euro bonds yet, and the reason for that is today to have Euro bonds, Michael, is like saying, you, my cousin, are going to do all the spending in New York for the holiday season, but the credit card is mine. I will have to pay all of your expenses. That's what is Germany's position. So in order to have I call them Eurozone bonds rather than Euro bonds to indicate that it is a region-wide bond. In order for that to really work, you need to have Germany be satisfied that there is fiscal discipline on the other side. So the Germans in return get the stability of the Eurozone finally. They don't have to have a very strong new Deutsche Mark or new Euro or whatever they are forced to go into without it. then you start to have the Eurozone bonds happen, not today.
Sri, I have to ask you this question. So you're talking about the prospect of the European banks, Eurozone banks, taking some fairly significant haircuts. And they're going to have to probably be, some of them be nationalized, which means the equity gets wiped out.
Exactly.
So why would you want to start going into the equity market before that actually happens? That seems to me to be the capitulation point, is if you think there's going to be nationalization, that's probably the point at which, that's like, you know, that would be the March 09 point for the European stock market, wouldn't it?
Absolutely. I'm not suggesting by any stretch of imagination that they go in before that happens. It is a question, you asked a question earlier, which is where I come from. Okay, is it too short a period of time to look at light at the end of the tunnel in the next 7 months? And the answer is that it's not too short, but you need to have those nationalizations and the haircuts take place and the success or failure of recapitalization before you go into those banks.
David,
so I agree with you. It's not before, but it's after.
Do you think we can get if we got something out of the European leaders, is the announcement effect enough? Because it's going to take a long time to put anything into practice.
Well, what happens is, well, and in some cases there might have to be, you know, if you're changing treaties, that might have to go through 17 different parliaments. But I guess what would happen is that if the ECB was convinced that whatever fiscal package was agreed to, or if, say, it is a common Eurozone bond, or some fiscal package that has teeth that the ECB has confidence in, then in the interim, till it gets passed, they would take on that role of lender of last resort for the sovereigns. And of course, that would have positive implications, I guess, for the banking system. But that would be the quid pro quo. I mean, if there's going to be the timeline to get all this stuff passed through the parliaments, the ECB would, I think, would have to step in, or else we're going to have another big leg down in the market.
Well, we got 500 points yesterday on an announcement from central banks that they weren't doing anything new, just changing the price of what they'd already said. If we got some announcement, what kind of move would we see in the markets?
Well, it depends on what announcement it is. If it is a case of haircut, and again, I will go with David on that, if it involves the banks taking major losses which are not yet discounted in the market price, you don't get a move up in terms of share prices. You actually get one more leg down before that happens. So I think the announcement yesterday worked because it was a liquidity boosting effort. What European countries are going through is a solvency issue. They have too much debt. So the reason for going into those long term would be when something happens, Michael, that's suggestive of the fact that the solvency issue is being tackled.
Yeah, if we get that, though, do we get 1,000 points on the Dow?
Oh, if you get that, you get 2,000 point run in the Dow Jones.
You could. I mean, if you take a look, I mean, how many times from the end of 07 to, say, the end of 08, I think there were at least 5 periods where the Fed, in conjunction with other central banks, I mean, the TAF is a classic example. There was about 5 different episodes where there was some liquidity event engineered by the Federal Reserve with other central banks. If you actually tally up the rallies in the Dow,
absolutely
3,000 points, right. And the market was down 50% over. So I mean, well, I think what we're in right now, and I think yesterday, look, when I look back at the historical data, daily moves in the Dow, 500 point moves. That doesn't normally happen in a bull market. That's actually more characteristic of the move you'll get in a bear market than a bull market. How ironic is that? It just shows how manically volatile this market is. That's what we're in right now, is a meat grinder.
It is manically.
I think we are talking, again, as David says, that liquidity-related measures can cause more increases, but they're not sustainable. They have to come down until you have a solvency resolving issue.
Everybody wants to drink the liquidity. Both of these gentlemen will be